Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. Investing can feel like stepping onto a giant playground where everyone claims to have the ultimate winning strategy, but few can actually explain how their strategy beats a simple index fund. Today, let's dive straight into the question: when is it better to own an ETF? And when should you go wild and pick individual stocks? Imagine you've just decided to invest some money. You've heard about ETFs, those exchange traded funds that track various markets or sectors. If a giant chunk of the investment world is wrapped up in these funds, they must be doing something right. An ETF is essentially a basket of stocks, bonds, or other assets that you buy in a single trade, which means you get a little slice of every security inside that basket. It's like paying one entrance fee to an all you can eat buffet and trying every dish on the menu. That in itself sounds pretty exciting, but there are multiple flavors of ETFs out there, each with its own ingredients. Some might track a broad index like the S and AMP Wink with tongue sticking out 500. Others zero in on a single sector: tech, energy, healthcare, you name it. There are even some that track commodities or bonds. It's a diverse universe, and picking the right ETF can be as easy or as complicated as you make it. Now, stepping back, we should clarify that ETFs have gained massive popularity in recent decades for a few solid reasons. They're convenient, traded like a stock, but diversified like a mutual fund, and often come with lower fees than actively managed funds. On top of that, they don't require you to check each individual company's quarterly earnings. You basically buy once and let the broader market do the heavy lifting. If the market as a whole goes up, your ETF hopefully rises along with it. But if everything crashes, well, you take the hit too. It's a group activity. Nobody wants a group meltdown, but at least you can take solace in the fact that your single holding isn't blowing up your entire portfolio out of nowhere. So you've got your ETFs, lots of choices, easy diversification, reasonably low fees. On the other hand, you have the thrilling world of stock picking. That's where you say, I am an investing genius who can outsmart the market, so I'm going to pick the best companies and crush everyone else. Or maybe you're just bored on a Tuesday night and decide that Apple, Tesla, or some obscure biotech stock is calling your name. In essence, stock picking means hand selecting shares of companies that you believe will outperform others, which can lead to bigger gains if you guess correctly. Many professional fund managers build entire careers on this approach, meticulously analyzing corporate earnings, balance sheets, and future growth prospects in search of that hidden gem. Of course, not all of us have the time or desire to devour annual reports like bedtime stories, so we trust the experts, or we roll the dice ourselves. A major selling point of ETFs is how they spread your money across multiple assets, instantly giving you a certain level of diversification. If one stock in the basket tanks, your overall ETF might only experience a small dip. If you try that same stunt in an individual stock, you're left at the mercy of a single CEO's next questionable tweet. On top of that, ETFs generally involve lower trading fees because you're not buying and selling dozens of different companies over time. You're just making a few trades in the ETF itself. There's also a minimal emotional roller coaster. You're not watching each earnings release like a hawk. Instead, you let the broader market's heartbeat guide your investment's fate. But let's not sugarcoat it. Even ETFs aren't a free lunch. They come with their own set of downsides. For starters, you can't brag at parties about how you discovered the next Amazon before it became the global titan it is today. You're part of the collective, riding the wave with everyone else. If your ETF tracks the entire market, you'll do as well or as poorly as that market. Also, some ETFs might have hidden complexities, especially those fancy leveraged or inverse ones, that can magnify risk instead of reducing it. Plus, if your ETF is heavily weighted towards certain large cap companies, you might unknowingly end up with a chunk of your money in just a few big names, undermining the very diversification you were hoping for. Stock picking, by contrast, gives you that tingle of excitement when you spot a company you believe in. You can dive deep, research the fundamentals, talk yourself into or out of an investment. If you pick well, you might beat the market handily. That's where you hear legendary stories of people who bought Apple in the 90s or Tesla a decade ago. But for every Tesla success story, there's a cautionary tale of a once promising stock that disintegrated, leaving investors with shattered dreams. Stock picking demands time, constant research, monitoring the news, reacting to earnings calls, or ignoring them completely and hoping for the best. Emotions can run high, and decisions can get clouded by fear of missing out. Some say it's almost like gambling, especially if you're trying to guess the next trend with zero due diligence. Fees and taxes deserve their own spotlight because these can nibble away at your returns more stealthily than a hungry raccoon in your backyard. ETFs typically carry a small expense ratio, basically an annual fee for the management of that fund. While many are ultra low, as in 0.05% or even less, those fees do add up over time. If you decide to go the route of stock picking, you have trading commissions, depending on your broker, potential spread costs if you're buying less liquid shares, and maybe even short-term capital gains taxes if you flip your stocks quickly. Dividends can also create taxable events. By contrast, some ETFs reinvest dividends automatically, which can be more tax efficient for a buy and hold investor. But watch out for distribution schedules and how your chosen ETF handles them. It may or may not be as efficient as you think. It's also helpful to look at historical performance. Over the long term, many studies show that most professional fund managers fail to consistently outperform broad market indexes. That's a sobering thought. The people who do this for a living often get beaten by an index tracking fund. Of course, that doesn't mean it's impossible to pick winning stocks or that you're doomed to mediocrity if you try. But it does reveal that consistently outpacing the market is tough, requiring a mix of skill, discipline, luck, and possibly a crystal ball. Which leads to the question, how do you choose your personal strategy? The honest truth is that it depends on you, your time, your interest in tracking companies, your risk tolerance, and your financial goals. Some folks love the thrill of examining a company's product pipeline or understanding how macroeconomic trends might influence an individual stock. Others would rather set their money in a broad ETF and forget about it until they need it for retirement. You can even blend both approaches, holding a chunk of your portfolio in a total market ETF while dedicating a smaller portion to some wild single stock adventures. That way, if your stock picks crash and burn, you still have a safety net in your ETF investments. No matter which route you take, risk and diversification are central themes. If you decide to pick stocks, consider how many different companies you want to hold, how they're spread across various sectors, and whether your selection leans heavily into a single region or industry. Diversifying reduces the impact of any single catastrophe, even if it also reduces the chance of a single stock's astronomical gains driving your entire portfolio into the stratosphere. On the flip side, not diversifying can bring out some major adrenaline rushes. Sometimes you'll look like a genius. Sometimes you'll look like someone who just threw darts at a board. For most people, slow and steady might be the more responsible approach. But let's be honest, responsibility isn't always the most thrilling concept. While deciding on your plan, you'll also need a brokerage account. Be mindful of transaction fees, minimum balances, and user experience. Some brokers are more user-friendly, with robust mobile apps, while others are cheaper, but have clunky platforms that feel like they were designed in 1995. If you plan to invest primarily in ETFs, check whether the broker has commission-free ETF trading. If you want to do frequent stock trades, check the commission per trade, or if they offer zero-commission stock transactions. The last thing you want is to watch your gains leak away because your broker charges you for every little move. If you're a beginner, it's worth starting with a few fundamental questions. What's your timeline? Are you willing to see your portfolio drop in a down market without hitting the panic button? Do you lose sleep over small price swings? Once you have that introspection nailed down, it's easier to figure out your approach. Some folks swear by the 80-20 rule, 80% in diversified ETFs, 20% in carefully chosen stocks you're excited about. Others go all in on index funds and call it a day. There's no single right answer, although you might hear plenty of folks on the internet claiming they know the only possible truth. If you want a real-world example, Look at how the broad S and AMP wink with tongue sticking out 500 ETF has performed over the last several decades. It may fluctuate, but historically it has trended upward. Meanwhile, individual stock pickers can either beat that benchmark or lag behind it, sometimes dramatically. One person might achieve a 20% return for a few years, only to underperform the index in subsequent years. Over a long enough timeline, the broad market approach has shown relatively consistent growth, whereas individual picks can be feast or famine. One good middle ground is to treat stock picking as a learning tool. You can keep most of your money in diversified ETFs, then put a small portion into stocks you believe in based on real research. That way, if your picks do incredibly well, you'll see a nice bonus on top of your main portfolio. If they flop, your overall nest egg is still intact, and you'll walk away with a valuable lesson on what not to do next time. Many new investors find this approach less stressful because a big chunk of their money is relatively safe in an ETF while they experiment with picking a few stocks. Some folks might claim that ETFs are for the lazy or that stock picking is an ego game. The reality is that it's not purely black and white. It's okay to want the stability and convenience of ETFs, and it's also okay to enjoy the intellectual challenge or potential upside of hand-picked stocks. The controversy emerges when people get into heated debates about which method is superior. Maybe it's just human nature to argue that our own chosen path must be the best one. In truth, the best path is the one that aligns with your specific goals, temperament, and financial situation. Either way, the world of investing is vast and, let's be honest, can sometimes be overwhelming. By comparing these two popular approaches, broad ETFs versus active stock picking, you arm yourself with more knowledge. Ultimately, the goal is to build wealth, or at least avoid setting your money on fire. So as you consider your next steps, reflect on how much time you want to spend researching companies, how comfortable you are with risk, and how you emotionally handle the inevitable ups and downs of the market. Then craft a strategy that suits you. If anyone tells you their way is the only way, just smile politely and remember that you're the one who has to live with the results.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you and take care of yourself and your finances.